is Corey here, founder and financial advisor at Verse. Now, we all know, it's news to no one, that Australians absolutely love their property. So much so, in fact, that we've got a tagline. That tagline is the Australian dream. Now, for most people, and most people that I know, they really view property as the vehicle, their investment vehicle, their chance to get ahead, to build wealth, to build equity, to set themselves up for them or perhaps their family, and further down the track, have more money to chase goals and chase dreams and have the experiences that are important to them. Now, that's what things look like in theory for most, but in practice, we see that executed well very scarcely, and we see it executed poorly very commonly. There are some common and consistent mistakes that property investors make. They make them too regularly. And the purpose of this quick video is to help you understand what those mistakes are so that you can avoid them moving forward and invest in property like a pro for you and for your family. So to do that, we have called in a property guru, director and advisor and father of two at Performance Property, Heath Bedford. Heath, how are you? And thank you for joining us, mate.
I'm very well, thank you, Corey, and thanks for the lovely intro.
You are more than welcome, and thank you for joining us. Now, just before we dive into what we're calling here 5 mistakes property investors make, tell us a bit about yourself, your background, and you and the team there at Performance Property.
Sure. So look, I've got about 16 years experience in valuation advisory of property across the country. About 5 years ago, we saw a real gap in the market for high quality, ethical, research-based advice. And myself and 3 business partners founded Performance Property, or what is known as Performance Property Advisory today, which is a national-based independent advisory firm researching the 30 largest cities around the country, which forms our advice model and allows us to research, acquire, and provide ongoing portfolio management for clients or investors that want to build wealth through property.
Thanks for the rundown. And for the disclaimer, we recommend Heath and his team quite a lot. Plenty of our clients will be familiar with Heath. So Heath, in terms of these 5 mistakes that property investors make, let's start with mistake number 1 that you're calling poor timing. In particular, not having regard to property cycles. Tell us a bit about that mistake, the impact of it, and how people come to make it.
Yeah, look, this is a really important one, and it's going to be more pertinent moving forward. There's really 2 elements to this, and the first one being timing the market and timing the cycle, and then also time in the market or spent holding the asset. So, look, we've studied the residential markets going back to the 1890s across Australia, and it's quite interesting. So since the 1970s, the average performance across all the major capital cities has been around 7% compounding growth per annum, or a doubling cycle every 11 or so years. Now, every city is a little bit different. The 5 major capital cities have all been about the same. And that's sort of easing out as we go into some regionals to 13 or 15-year cycles. Typically, and that's across the housing market, units obviously less so. But typically what we see in that 11-year cycle is between 6 and 8 years of above long-term trend growth, and anywhere between 4 and 7 years of what we determine as price stagnation, where growth is pretty flat, moderate, or even price declines. So it's important that you're buying at the right point of the cycle. For example, the Sydney market last peaked in 2003, and for a period of 8 years, the market only moved about 20-odd%. So the market didn't hit the bottom until around 2011, and it's obviously been on a significant growth spurt since then over the last 5-6 years, performing around 80%. So as you can see there, timing is very important. So particularly now as we move into the peak of the cycle for some cities, Melbourne and Sydney obviously being the main ones, negative cash flow assets and stagnation periods don't bode well. So it really hinders that ability to build equity and to continue to build the portfolio. So that's why we generally see more than 70% of investors getting stuck at 1 or 2 investment properties.
Because of that poor timing. So in terms of helping people, I guess, manage that timing aspect, How is the average Joe out there meant to know when a market's showing value, and also when maybe in the case of Melbourne and Sydney, a market's fully priced? What do they look for? What are the indicators that they should be able to see?
Affordability is a key one that we look at, and what that is a measure of the median income into servicing the median mortgage at that point in time. And that's a metric that we've looked at going back 30 odd years across every city. And that's an interesting one. So, Sydney's sitting about 60% at the moment. So 60% of the average wage is required to service the average mortgage. We've seen that less than 3 times in the last 30 years. And whenever that metric has been that high, house prices have come back. Melbourne's sitting around 45%. And historically, when it's hit that sort of level, prices have struggled to grow or have come back. That's a clear sign. Demand, for those out there, jump on realestate.com, look on the Invest tab and go to a relevant suburb, and visits per property is a good hit. So the average across Victoria is about 1,000 hits per property. Anything sub 600 shows you that the market's pretty soft. And we're seeing some quite blue chip suburbs in Melbourne where the average visits per property is say 200, 250, maybe 300. Indicating that there's a real lack of buyer activity out there.
Well, hence why we're seeing all the heat come out of the Melbourne market and also the Sydney market as well. Both of them have come off into that.
Yeah, and another good rule of thumb is if a market has been outperforming its long-term growth rates for more than 3 to 5 years, you've probably missed the boat. So you've seen 35, 40, 50% capital growth within a 3 to 5 year period. I'd be very wary of that market.
Yeah, that's something we see. FOMO is certainly something that can take hold. We've all got a bit of FOMO, and property investing is no different. Now,
in 16 years of real estate, Corey, I've never seen so much noise and misinformation out there in the media.
Yeah, well, that's why you're here, Heath.
Exactly. Bugbear. The second point I had to that was the time in the market or spent in the market. And property investment is a long-term game. And we find that investors get too fixated on the short-term hit, expecting extraordinary capital growth within 2 or 3 years. You need to take a 10-year view. Property has very high entry and exit costs, and it's very cyclical. So, whilst the market may be representing value by being at the bottom of the cycle, it may still have moderate growth within the short term, but over a 10-year, 12-year period, it should outperform. And the inverse of that as well, that if you're buying at the top of the cycle, you might get your short-term hit, but in the medium to longer term, 5, 7 year period, you might see very little growth or below average growth.
Well said, Heath. We're off to a good start here. Now, mistake number 2 is the wrong asset and the wrong location selection. Something I see consistently all the time with clients that we meet, less so with clients that we work with. Tell us a bit about that mistake.
2 absolutely crucial and non-negotiable attributes. Basically, asset selection is crucial. So different locations and different types of assets have different growth profiles. A good example of that is Melbourne. And if you look at metropolitan Melbourne and the performance of Melbourne, and we're saying that it's performed at 7.5% compounding per annum over the long term. If you think of Melbourne as concentric rings, generally what we see is the inner and middle ring suburbs performing in line or above. And as you get further out, that long-term growth rate dropping. And the reason for that is the scarcity of land. And then obviously assets. So housing has outperformed units, and residential investment is primarily about capital growth and the ability to leverage off the equity that you build. Buying off the plan is a big no-no. So we don't touch anything off the plan. We don't buy any house and land packages for clients. It's a high risk area. Our research department at the moment is showing that the average high-rise off the plan purchase in Melbourne is taking around 6 years to recoup the ingoing purchase price, and that's obviously a huge opportunity cost. Where we've had clients that have come in and they've bought off the plan in blue chip South Yarra. They've spent $500,000 or more, and the property is lucky to be worth that today if they can sell it. Whereas if they had put that into a middle ring house, they're more likely to have doubled. So another issue is buying in the area that they live or they grew up in. They're emotionally attached to it. Is not necessarily the best investment decision.
So just with off the plan, because this is a really common mistake that I see quite often for younger buyers too, that have a limited budget. So they're at the bottom end of the market and they're not looking at 4-bedroom houses in Brighton. If they're in Melbourne, they're looking at some of these off the plan developments. They're looking at 1-2-bedroom apartments, and quite often they really do get burnt. And it's not until they go and get advice and they see a financial advisor that they actually recognize that maybe they haven't got that right, and there might be some work to address that issue and resolve it. So if we could dig into that, you mentioned about that 6-year time period. So that's from the contract price in which the property was purchased for to when the value is again at that price. Explain to us how that actually comes to be. Now, why is it that there's a contract price you can agree upon, and then when you get the valuation done at the time of settlement, there can be a large discrepancy? What drives that discrepancy, and what are people missing, and what are the hidden scams or whatever you want to call it within buying off the plan that does people gets them undone?
That's a really good question, Corey. Look, there's probably too much to go into today, but at a high level, buying off the plan, the easiest way to put it is like buying a car, a brand new car. As soon as you drive it out of the showroom, it's worth 5, 10, 15, possibly 20% less. So the off the plan market is artificial. So the prices have been determined by the developer. The profit margins have been loaded into the purchase price. A lot of buyers are sucked in by reduced or no stamp duty, when really the developers are just putting these in anyway into the price. So the prices haven't been determined by the market, and when it comes time for the bank, they'll send a valuer out there to assess whether it's a contract price. They're under strict instructions to disregard the contract price and to look at comparable sales of newly developed, not off the plan sales, resales, either within the building or surrounding buildings. And quite often what we see is that they're 5-10% less. And certainly in my valuation experience, providing mortgage valuations for banks, that particularly 1- and 2-bedroom apartments, be anywhere from 10% to possibly 20% below contract price. The other factor is just changes within the market. We haven't really seen that so much in Melbourne, where if it's a 2-year construction period, you could have some significant changes like we're seeing now. So there's a real risk at the moment for off-the-plan purchases or buyers that are entering contracts today, whether those contracts will be worth, or that those properties will be worth that in, say, 2 years' time with a declining market.
Yeah, it's something we've met many clients that have purchased off the plan, and in the 3.5 years we've been operating, we haven't had a client purchase off the plan, and I can't see a time when we're gonna give that the green light. So one thing I want to delve into here is around the wrong asset and the wrong location is the concept of investment grade. Something I hear you talking about quite consistently, the property is investment grade or it's not investment grade. Can you explain what that term means and tell us a bit about what percentage of properties would you deem investment grade and what percentage would you not?
Yeah, good question. Look, investment grade is an interesting one. It all comes down to location. So at the end of the day, we want to be buying in a high quality location that has a scarce land supply. So we don't want to be buying in high supply or high risk areas. We want to be buying at or below median value. And the reason for that is that is the largest buyer pool. So it's important, particularly when it comes to selling the asset, which at some point in time the asset will be sold, that we're appealing to as broad a market as possible. So we're not buying $1 million property in a $500,000 area where the property's been overcapitalised. We want to be buying below market value. We want to see a high land value to asset value ratio. So when we're assessing a property, we're valuing the land and then we're valuing the improvements. And our rule of thumb is that we want to see 60 to 70% or more the total asset value tied up in the land. That is the scarce commodity. That's what drives price growth. We want to be buying in areas that have strong owner-occupier appeal. So quality streets, quality position, close to good amenities, good quality schooling, close to job nodes, public transport, etc., etc. And when we talk about the streetscape, we want to see homogenous housing. We don't want to see housing commission and a mix of different eras and unit blocks and whatnot. But ideally, we're buying in older established areas that have character housing. We're looking for value add potential. So ideally, we want to see assets that have either cosmetic refurbishment potential, further extension potential, or subdivision potential. Now, not all clients want to be developers, but that inherent upside stays in the land value and can be passed on to the next purchaser. Or if the market does stagnate or flatten, gives the investor the opportunity to manufacture capital growth and equity to continue to build their portfolio. Most importantly, we want an asset that's liquid. So
what does liquid mean for the people out there? Isn't liquid something you drink?
Well, in asset terminology, you've either got a illiquid asset or a liquid asset. And what we mean by that is an asset that can be sold relatively quickly in a poor market or a strong market. So for us, it's about de-risking the process for clients. And the markets don't always perform, or client circumstances change, and they may need to divest an asset. So buying in areas where there's strong owner-occupier demand, there's strong investor demand, is very important. So and also a property that is rentable and delivers consistent cash returns. That's really important. So and that's at an asset level. And then when we're looking at markets, we ideally want a very robust economy. So we don't want to be buying in towns that are reliant on one industry or one or two industries. Mining towns are a good example.
Yeah, I mean, you've covered a lot of ground there, Heath. And one thing that stands out for me is that most people have overly simplistic views about what it takes to invest in property well. But it's more complicated than that. It doesn't mean there's complicated things. It means there's a lot of things you need to consider and understand to take into account if you're going to make good decisions. And that's not just a property thing. I think most things we don't have a lot of knowledge about. We just form overly simplistic views about. And when it comes to the finances, that can be quite costly. So
yeah, look at Melbourne. People within Melbourne can be a bit blasé about property. I just think it continues to grow. And if you've invested in property any time over the last 20, 22 years, everyone's done well. Whether you've bought an A-grade asset or a C-grade asset, the market has consistently performed, which hasn't been the long-term trend, and it hasn't been the trend across other cities. Melbourne was flat for 7 years between 1989 and 1996. And the first thing people say to me is, well, that was a recession. I say, yes, but other cities around the country saw price growth.
Yeah.
You need to look at the macro fundamentals and also the micro fundamentals. But what really irks me is people think they're just going to buy a property and that's property investment's easy. It's not easy, and you're going to get much harder moving forward. And that's what we're saying to clients, that no longer can you just go out and buy a property and do well. You need to have regard to the timing of the market, the time in the market, the asset that you're selecting, and also the market. Buying Melbourne, Sydney at the moment at the peak is very high risk.
Very well said, Heath. I'm going to keep us moving. Mistake number 2 we could spend all day on in reality. Mistake number 3 is using emotion to make your decision. Tell us a bit about why emotion is dangerous when it comes to investing in property.
Emotion's a big no-no. So we strip out all emotion. It's all about the financials for us. So you just need to think about, if you're looking for a home, completely different. There's emotion attached to that, and that's why we've split our businesses between investment and home buying. But when it comes down to investment buying, you just need to be business minded. It all comes down to the financials. If they don't stack up, move on. Simple as that. So always focus on capital growth, the rental returns, and the fundamentals that will ultimately drive property growth: demand and supply, money supply and confidence. So jobs, what's going on in the job market, what are the infrastructure projects going on? Is that going to create wage growth and create more jobs? How's business and consumer confidence? It's obviously really important. And obviously, finally, sort of affordability. Affordability is a big issue. And, you know, it's funny, you look at Melbourne and Sydney and the data looks fantastic. You know, population growth's good, the economy's strong, confidence is strong, extremely unaffordable. And that's why we're not seeing price growth in those markets. That's why we're actually seeing price declines.
Well said. I'm going to keep this moving. Mistake number 4 is a lack of solid research and due diligence, or DD. Tell us a bit about the kind of research people need to do and the research mistakes that they don't do that in turn end up leading them to buy the wrong properties.
Yeah, this is one of the most crucial elements of investing, and where a lot of buyers get unstuck. They might have bought in a good area, but they've bought an absolute dud because they haven't completed a thorough due diligence process. And that's at the heart of our model, that we have a very thorough DD process. And as we work through that process, if anything's not passing, then we're simply walking away from a deal. But it's really important to understand the location and the drivers and the demographics, both from a buyer's point of view and also tenants. So we want to be buying in areas where both there is owner-occupied demand to buy and also renters to rent. Understanding the housing type that appeals to the market is obviously very important. And then obviously the market itself. So making sure, looking at the supply pipeline, you know, what's the vacancy rate? 2.5%, 3% is a balanced market where you generally won't see significant price or rental increases or decreases. And your vacancy period's probably running at 2 to 3 weeks, maybe 4 weeks. But obviously above that, and the market is oversupplied, and you start to see downward pressure on rents and blowout in vacancy periods. So we want to be buying in areas that have low supply, where the vacancy rates are ideally under 2%. Most importantly, on the asset itself, invest the $500-$600 in getting a building expert and a pest expert out there and inspect the property thoroughly. You know, and particularly with the rise of shows like The Block and all those renovation shows, you know, we're seeing more DIY renovations done, and they're not quality workmanship. So spend the $500-$600 it costs to get those reports undertaken, because it could ultimately cost you thousands by buying an absolute lemon. Undertaking things like flood checks. If you think it's a big block and it might have subdivision potential, you know, do a dial before you dig. Even though it doesn't have any easements, there could be other underlying infrastructure there that could hinder subdivision potential. Do council checks for permits. Has there been recent renovation works done? Is there a converted garage that's now a habitable room? That could actually be illegal and could hinder your finance getting through once the valuer goes out there and checks. And finally, most importantly, always obtain legal advice. So always have the contract checked by a qualified solicitor or conveyancer.
Sage advice, Heath. One thing that we see in terms of a lack of research quite often is we'll meet people that might become clients, and they might get in touch saying, we're looking at buying, you know, an investment property or expanding on our investment property portfolio. And also, look, you know, tell me a bit about what you're thinking and what your intent is. And also, look, we're looking at buying in Wheelers Hill in Melbourne. I said, well, tell me a bit about why Wheelers Hill. You know, and they might say, well, that's kind of where we grew up and we live not far away and we know the area and they've got this shopping centre being built and, you know, a few of these things. And ultimately, their views are just largely conditioned by their own experience, where they grew up, where their parents bought a home there and they did well over that 20, 25-year period that you mentioned. And they give no thought to perhaps, you know, what other markets could we be in? And you might want to touch on the concept of borderless investing, which is something instinctively very few property investors do. They just stick with the areas that they know, whereas those areas might not be the right areas to be looking at all in the first place.
100%. We get this all the time. I live in Wheelers Hill and I'm going to buy a unit because that's what I can afford. I like living there. I can see other people wanting to live there. And as you touched on, you know, there's a new shopping centre being built, or there's a new school going up and there's going to be high demand, this and that. But it's like saying, I've got CBA shares and I'm going to buy more CBA shares, or I've got CBA shares, I'm going to buy more Westpac shares. That's a simple analogy. You're still putting your eggs in the one market, and if that market lays dormant or declines, you're in a worse position. There is 15,000 suburbs across the country. There are 550 odd local government areas across the country. There are many markets, and those markets have performed just as strongly, if not more strongly, than the market that you're living in. And that's what we do. We have a national view. We study the 30 largest cities, and we're actively investing and putting our own money in other markets at the moment, and have been telling our clients to do so for the best part of the last 2 years. Don't get me wrong, when we first started the business, we were very active in the Melbourne and Sydney markets, but more recently we're seeing better value in other markets, and historically they have performed. So broaden the horizon, take the emotion out of it, and it's ultimately going to deliver a better outcome for you.
And one other point I've got to make on the lack of research is, we so consistently hear people tell us that they intend to buy an investment property to save tax. There's a lot of false assumptions and misunderstandings around negative gearing, what it actually is. We've got these positive associations with negative gearing generally, and we view it as a reason to buy property or as a property strategy. But in fact, it's not a reason to buy property, and it's not a property strategy. So could you, with as much simplicity as you can, explain what negative gearing is and why that shouldn't be the driver behind you getting into property?
Yeah, look, we get this all the time. And another one of that is depreciation. So they're not strategies. They're possibly some benefits depending on your situation. Negative gearing simply is where the income from the asset does not cover all the outgoings associated with buying the property, or the running costs. So there is a negative cash flow each and every year. And the premise of that is that obviously you get a tax deduction depending on your marginal tax rate, but you don't enter into an investment to make a loss, do you? So you need to see capital growth, and just about a majority of the Australian residential market, because yields are so low, particularly Melbourne and Sydney, where yields are all-time lows, where rents are simply too low.
Just to confirm, so yields is a percentage return of income or rent based on the property value?
Correct, yeah. It's the total rents as a percentage of the market value.
Sure.
So there's a large negative cash flow to hold those assets year on year. And if you bought, say, a $600,000, $700,000, $800,000 asset in the Melbourne or Sydney market, and you borrowed 80%, you might be running at a $20,000 to $30,000 per annum shortfall before tax in the current climate. And that's before we see a conversion to principal and interest, or an increase in interest rates. So the whole premise is that you need to see capital growth, and if you're not seeing capital growth, you're in fact going backwards. So that's why it's important to, if it is going to be part of the investment, that you're buying a growth orientated asset.
Yeah, that likely further down the track, it won't actually be negatively geared. At some point, it'll be positively geared when the rent's risen.
As you pay down the principal of the loan, and over the years, as you see rentals increase, over time, the asset will become neutral to positively geared. And that's the idea, that you pay down the debt and get rental growth, and it starts to become a cash flow positive asset. And that's important when you're constructing a portfolio, that you have a balance of growth orientated assets and also passive income assets.
So for all those out there, just to clarify, if you have an investment property and your income, your rent is, say, $10,000 for the year, normally it's going to be more than that, with the simple numbers, and your expenses are $20,000 for the year, you've got a loss of $10,000 there. You don't get that $10,000 back in your tax return. You can claim the $10,000 loss as a tax deduction, and then part of your refund is based on that tax deduction. So if your tax rate, as an example, is 32.5%, you're going to get 32.5% of that $10,000 loss back in your refund. So in simple terms, you're losing $1 to save 32.5% in tax, which doesn't make any sense ever unless the thing that you've purchased, your asset, is rising in capital value, as you've said really well, Heath. So crucial that people understand that and that not be the motivator for getting into property. It's just a tax event, more so than a strategy. Mistake number 5, Heath, is poor cash flow management. Tell us a bit about poor cash flow management when it comes to property investing.
Yeah, there's really 2 elements to this, and it's becoming more and more important as the banking environment changes. And I'm sure a lot of your clients at the moment, like a lot of our clients that are going through lending at the moment, the landscape is very different to what it was 3 months ago, let alone what it was 2 years ago. It is a lot harder to get access to capital at the moment. And what we're hearing from a lot of mortgage brokers out there at the moment is that banks are really looking to cap lending to a maximum of 4 times household income. And over the years, what we're seeing is banks being quite willing to lend, say, 6, 7, 8 times income, even in some circumstances. Now, if you look at Sydney house prices, they're 14 times income at the moment. Melbourne's 11 times income. So there's quite a wide gap there at the moment. So what we're advising our clients, and we always advise our clients, is to not overstretch. So just because the bank is telling them, oh, look, we'll lend you $1 million, doesn't necessarily mean that you can afford that. And to factor in the likelihood of interest rate rises, the switch from interest only to principal and interest loans, and ensuring that there's enough of a serviceability buffer, especially if there's lifestyle changes, i.e. kids come along, kids going to private schools, possibly a changing career and changing income. The factor that we see investors not taking full account of is all operating expenses for the assets. So what I mean by that is all the outgoings. So things like property management fees, repairs and maintenance ongoing. Assets, just particularly older style assets, they're not just set and forget, so to speak. Vacancy periods, always be factoring in 2-3 weeks vacancy per year. Hopefully that doesn't happen every year, that you get a tenant that's in there for 3, 4, 5 years or an extended period, but to have that safety net. A good rule of thumb that we use is to set aside around 25% of your total rental just for outgoings. Look, if there's a significant negative gap between the repayments of your investment, then your cash flow will be challenged. And ultimately you need cash flow to continue to build your portfolio. And particularly in this environment where banks don't really care what assets you've got. They want to see serviceability. They want to see income.
Yeah, all the focus now from a lending point of view is on serviceability, and that's got significantly more difficult. The past couple of years, as regulators, APRA, have sought to kind of cool the property market, particularly in Melbourne and Sydney, and I dare say it's worked really well. I think they're really pleased with the outcome they've got, where the market has cooled. It's started to ease off, but by no means do we have a market that's falling quickly either. So I think that's been done well.
And been tested by APRA, the banking police, so to watch.
Yeah.
And also the state and federal governments. They've been tinkering around the edges. The Liberals have tightened up negative gearing benefits. We've seen a number of surcharges and taxes to limit foreign investment into the country. And all of these are starting just to cool what are the 2 hottest markets, or have been the 2 hottest markets in the country.
Yeah, well said. I think on the cash flow side of things, people tend to just hit and hope. And what I mean by that is they don't do much preparation, they don't do much modelling, and they just go into the property. They know that the lender's going to give them enough to make the purchase, and they hope that it works out. And sometimes they will run into some roadblocks where if there is vacancy periods, or they can't get the rent that they were hoping for, or maybe they do have that next child and one of the couple is out of work for a period of time, and ultimately these things can force you to sell an asset that you don't want to sell, perhaps at the wrong time. But also too, just more generally, cash flow is the thing that's most highly correlated to how you're feeling about your finances and your level of stress. So tight cash flow, poor cash flow means a stressful life, and it means going without some of the things that you really value as well, which is not where you want to be. So I think it's a really important point that you make there, Heath. So that's it, guys. We've covered 5 of the mistakes that property investors make. Heath and I were chatting just before we hit record that we could have made a much longer list than 5, and we could have taken up much more of your time, Heath. So I really appreciate you joining us today. Before we do conclude, perhaps just tell us a bit about how people can get in touch with you or your team if they're looking for any advice around buying or reviewing investment portfolios or development or any other things that you and the team there might do.
It's been my pleasure, Corey. Best way to find us would be www.performanceproperty.com.au, or to get in touch with the Verse team, and I'm sure they'll be happy to pass on my contact details.
Beautiful. Well, again, Heath, thank you for joining us. We appreciate your insight and your wisdom. You've been in it a long time, and you've accumulated plenty of knowledge that's going to help people make better decisions going forward. So for that, we thank you. And I dare say this has been so valuable that we might try and get you on in the future as well, and share a bit more of that knowledge that you have got in your pocket there. So thank you, Heath, and we'll talk with you soon.
No problem. It's been my pleasure. Thanks, Corey.
Thanks, mate.